Understanding Market Indexes, a comprehensive guide. What is a market index? A market index serves as a vital tool in the realm of finance, representing a hypothetical portfolio of investment holdings that embodies a segment of the broader financial market. It's essential for investors looking to gauge market movements and performance. Structure of a market index. The value of a market index is determined by the prices of its underlying assets, and specific methodologies guide its calculation. Indexes can employ various weighting schemes, including 1. Market cap weighting. The index value is influenced more by larger companies, where companies with a higher market capitalization have a more substantial impact on the index's movement. 2. Price weighting. This method gives greater significance to stocks with higher prices, such as the Dow Jones Industrial Average, DJIA. 3. Float weighting. This approach considers only the shares available for trade, excluding those held by insiders. 4. Fundamental weighting. In this method, companies are weighted according to financial metrics like revenue or book value. Significance of market indexes. Investors typically track various market indexes to understand the fluctuations within financial markets. The United States features prominent stock indexes, including Dow Jones Industrial Average, DJIA, S&P 500 Index, Nasdaq Composite Index. In the bond market, the Bloomberg U.S. Aggregate Bond Index stands out as a reliable benchmark for U.S. bonds. Understanding a market index. Market indexes serve as a specific measurement of the value of a portfolio composed of holdings with defined market characteristics. Each index provider maintains its own methodology for calculating the index values, which can influence how they reflect market trends. The role of market indexes. Investors and fund managers utilize market indexes extensively. For instance, fund performance is often benchmarked against a relevant index to gauge how well the fund is performing in comparison to market standards. This practice not only aids in portfolio management but also helps ensure transparency for investors. Types of market indexes. The variety of market indexes available allows for targeted investment approaches. Some indexes represent broad segments of the market, while others focus on specific sectors, industries, or thematic areas. For instance, broad market indexes, DJIA, S&P 500, and Nasdaq Composite represent major segments of the market. Sector-specific indexes, indices like the Nasdaq 100 Technology Sector Index reflect the performance of technology stocks. Geographic indexes, the FTSE 100 tracks stocks primarily from the United Kingdom. The methodologies used in index construction play a significant role in how each index reacts to market changes. Market indexes as benchmarks. Indexes act as benchmark comparisons across financial markets for multiple purposes, including portfolio performance evaluation. Fund managers compare performance against benchmarks to determine effectiveness. Investment strategy development. These benchmarks can guide investors in constructing portfolios that reflect specific market segments or sectors. Index funds, a practical approach. While individual investors cannot invest directly in an index, they can acquire index funds. These funds aim to replicate the performance of market indexes by holding the securities that constitute the index. The benefits of index funds include lower costs. Index funds often have lower fees compared to actively managed funds because they do not require extensive research or management. Diversification. Exposure to a wide range of securities reduces the risk associated with individual stock investments. Examples of major market indexes. Some leading indexes include S&P 500, comprising 500 of the largest U.S. companies. It represents a significant portion of the market. Dow Jones Industrial Average, the oldest U.S. index, featuring 30 major corporations. Nasdaq Composite, focused primarily on technology and growth-oriented companies. Russell 2000, represent small-cap stocks in the U.S. market. The value of indexes to investors. Indexes simplify the process of market analysis by providing a snapshot of market segments, thus helping investors make informed decisions without needing to analyze every single asset. This allows for strategic investments tailored to market conditions. Frequently asked questions. What are the major stock indexes? In the United States, the most frequently referenced stock indexes are the DJIA, S&P 500, and Nasdaq Composite. Internationally, the FTSE 100 in the UK and the Nikkei 225 in Japan are notable examples. Why are indexes useful to investors? Indexes provide a simplified view of large market sectors, allowing investors to gauge market trends without needing to monitor every asset. What is the most widely cited U.S. stock index? While the DJIA is the oldest and most cited, the S&P 500 is often viewed as a more comprehensive representation of the U.S. economy. Final thoughts. Market indexes are pivotal in understanding market movements and performance. By employing various methodologies, these indexes capture the dynamics of financial markets, guiding investment strategies, and facilitating diverse investment options through index funds. For both institutional and individual investors, market indexes can simplify complex financial landscapes and serve as reliable references for making informed investment decisions.